What if I told you that Warren Buffett didn't become rich by finding the next big stock, but by buying great businesses when everyone else thought they were too cheap? That's the core idea behind value investing. And today, you'll learn the strategy inspired by the intelligent investor that helped shape Buffett's legendary approach to building wealth. Imagine you're walking through a store and see a $100 product being sold for just $60. Would you buy it? If you knew the product was actually worth $100, the answer would probably be yes. Value investing works with the same basic principle. Instead of asking, "Will this stock go up tomorrow?" a value investor asks, "What is this company really worth, and can I buy it for less?" That simple question can completely change the way you look at the stock market. The concept of value investing is strongly associated with Benjamin Graham, the legendary investor and author of The Intelligent Investor. Graham taught that the stock market is not always rational. Prices can rise because people are excited. Prices can crash because people are terrified. But the underlying value of a good business doesn't necessarily change as dramatically as its stock price. And this creates opportunities. Think about it this way. A company might be worth $100 per share based on its earnings, assets, competitive advantages, and future potential. But during a market panic, investors might sell aggressively and push its stock price down to $70. The value investor doesn't automatically panic. Instead, they ask, has the business actually become worth less, or has the price simply fallen? That distinction is everything. Benjamin Graham used a brilliant metaphor called Mr. Market. Imagine you own part of a business with a very emotional business partner. Every morning, Mr. Market shows up at your door and offers to buy your share. One day, he says, "I'll pay you $100. The next day, "I'll pay you $70. Then suddenly, "I'll pay you $130. Has the business really changed that much overnight? Probably not. Mr. Market is simply emotional. Sometimes he's optimistic. Sometimes he's terrified. Sometimes he becomes completely irrational. And according to Graham, you don't have to follow his emotions. You can simply wait for the price to make sense. This leads to one of the most important concepts in value investing: the margin of safety. Let's say you estimate that a company is worth $100 per share. Would you buy it at $99? Maybe. But what if you could buy it at $70? Now you have a much larger margin of safety. The idea is simple. Don't just buy something because it's valuable. Buy it when the price gives you room for error. Because investors make mistakes. Your valuation could be wrong. The economy could change. The company could perform worse than expected. A margin of safety helps protect you when reality doesn't match your predictions. And this is where Warren Buffett enters the story. Buffett studied Benjamin Graham at Columbia Business School and became deeply influenced by his approach. But over time, Buffett evolved beyond simply buying cheap stocks. He began focusing heavily on high-quality businesses with strong competitive advantages, excellent management, durable earnings, and the ability to generate cash over many years. In other words, Buffett learned that sometimes the best investment isn't a mediocre company at a bargain price. It can be an exceptional company purchased at a reasonable price. That shift became one of the defining ideas behind Buffett's investment philosophy. So what can you take from value investing if you're not a professional investor? 3 things. Number 1, stop obsessing over price alone. A stock being cheap doesn't automatically make it a good investment. Number 2, understand what you're buying. Before investing, learn about the company, its business model, finances, competitive advantages, and risks. Number 3, think long-term. Value investing isn't about getting rich overnight. It's about patiently buying assets that you believe are worth more than what you're paying and allowing time and compounding to work. And perhaps most importantly, don't let Mr. Market control your emotions. The stock market will always have fear. It will always have hype. And it will always have people trying to predict what happens next. But value investing teaches a different mindset. Don't ask what everyone else is buying. Ask, what is this really worth? That question alone can make you a much more rational investor. Now I want to know. Would you rather buy a great company at a fair price, or a mediocre company at a huge discount? Tell me your answer in the comments. And if you want to learn more about money, investing, and the psychology behind building wealth, subscribe to Money Momentum. Because here, we don't chase money. We build momentum.